Hi, folks. This is Mike Zlotnik, Big Mike. And today's discussion is going to focus on residential versus commercial real estate. What is likely going to offer better ROI, return on investment, in this part of the real estate cycle? As usually, this is for informational, educational purposes only. No advice is given, nothing is offered, no solicitation. I'm going to discuss some forward-looking statements, obviously highly speculative in nature, unknown what the future will hold. So take this purely as education. If you're looking to make an investment, consult with your attorney and CPA professional before writing a check. Anyway, this conversation is actually a strategic discussion on where we are in real estate cycle, and there are cycles that apply to different asset classes differently. In other words, residential real estate is at a different place in its own real estate cycle. Commercial is in a different place as well. And a commercial is a broad term. There are multifamily, storage, shopping plazas, office, industrial, and so on and so forth. Each of those sub-asset classes in real estate is in a different part of a real estate cycle. So let's start with residential, just talk a little bit about that. So residential properties are still doing well. The prices are pretty stable in most markets. Some markets have corrected a little bit. The hyper-growth, overheated market have corrected to a degree, simply because the interest rates have risen a lot, which killed off the demand. But the supply is very, very limited across the entire United States. There are some markets where supply is obviously plentiful, and some markets where supply is incredibly short. And the problem with the supply of properties is many people have bought residential real estate, which is, just to be clear, 1 to 4 doors, single family residential, townhouse, or just a house, SFR, single family residential, duplex, triplex, and quad. Those are the types of investments that fall to residential. Anything over 4 doors, 5 doors or more, is considered to be multifamily. Small multifamily, but it's still considered to be multifamily. Anyway, 1 to 4 doors residential, the supply is very, very limited. And the reason for this is that most investors and homeowners, owner-occupied properties, have been financed or refinanced with fixed-rate debt mortgages just a couple of years ago. And these very low interest rates is a great asset. These mortgages, fixed-rate, 30-year mortgages, 15-year mortgages, investors just don't want to give up on these assets. So they're holding on to these properties, they're not selling, and as the result, supply is very, very limited. New construction is very, very limited because the interest rates have risen. It's a lot less attractive for developers to bring these properties to the market because of the much higher cost of capital. So very limited supply, somewhat weakened demand with high interest rates is creating a market that is transacting in lower value, number one. Number two, discounts is just not happening because the owner distress is not there. There's no motivation for owners to sell. Unemployment is very, very low. Most folks are employed, they have a job, they can pay a mortgage. It's not an issue at all. So from that perspective, residential real estate market looks stable. The problem is for the forward money. When the forward money comes in, it needs to buy, and it's not getting any discounts on a sale price. There's no discount, and the interest rates are higher than they were a year and a half ago. The cost of debt service is way, way, way higher than it was before. So the cash return on equity is just very soft. It's not looking attractive at all. And the appreciation really is somewhat of a function of the rent growth. The rent growth has been strong during the post-COVID era, but the forward outlook on rent growth is slowing down. Rents in some markets are retreating. They're actually softening. In some markets, they're growing pretty slowly. Now, this doesn't say the rents will not continue to inflate, but they'll probably be growing at a 2 to 3% a year, your typical inflation type of rent growth. So the forward returns are steady, but they're not spectacular by any means. And it's really a function of the kind of debt you can get today. Now, we've seen some really interesting ideas in the market where some of the sellers of these properties that want to give buyers some incentive, they typically keep the price up, they keep the price high, but then they work with lenders to buy down the interest rate on the mortgages to make it more attractive for investors to come in and get a lower rate mortgage with a buy down. But that buy down costs money. So it's coming out of somebody's pocket. Some out of buyer's pocket, some out of seller's pocket, as a sort of as a, not a concession to the buyer, but just a concession to help the buyer get a lower rate mortgage. So all that stuff is happening. And in my view, again, residential real estate at this point sort of is at the peak. It has reached kind of the top of the expansion phase, and it's beginning to potentially go into the hyper supply phase. Now, the hyper supply phase normally has hyper supply, but there is no hyper supply. That's why you make the argument that residential real estate is sort of at the very last phase of the expansion, and it will go into a form of a hyper supply over the upcoming months. So again, hyper supply is purely name of the phase of the cycle. It doesn't mean that we're going to see massive amount of supply. Affordable real estate is just been an issue in the United States. There's not enough product, there's not enough supply. So we may not see the classic traditional hyper supply, as this real estate cycle is very different from many other traditional cycles because of the COVID and the impact of fiscal stimulus, COVID issues, and so on. Now let's go into the commercial type of real estate. So commercial real estate gets bought typically on shorter duration loans. So 5-year loans, in some extreme cases, 10-year loans, and that's the fixed term of a loan. Now loan amortization may be on a 20-25-year schedule, but it's still, the term is 5 to 10 years, and these are typically stabilized properties. And then you also have bridge debt. Bridge debt has helped investors to buy properties that need value add. There's some improvement, repositioning, improvements to the property, rent increases, and a lot of investors have bought properties with these short duration bridge loans. And many of these bridge loans were floating rate loans. Basically, they were floating with one of the indices out there. Could be a prime, could be LIBOR, could be SOFR, a number of other indices that are linked to where the interest rates are today, where they're trading in relation to what Fed is doing with the Fed funds rate. Fed funds rate has gone up, and the interest rates on many of these loans has been pushed from, say, 4-5% range to 8 to 9% range. It's a very, very substantial increase. Now, many prudent operators bought rate caps. Rate cap is simply an insurance policy. It's a contract. You're basically buying a contract that says if the interest rate goes up above a certain level, the policy starts paying you, the owner of the policy, the delta between the cap and what the market rate is today. So in other words, if a loan property was bought with the interest rate, let's just say at 4.5%, and the rate cap was 5.5%, that all the rate increase above 5.5% being covered by the insurance policy that just pays the owner of the policy cash every month, and that cash is paying the extra cost on the mortgage policy. That's how the rate caps work. So here's the discussion on the commercial real estate, because really interesting opportunities are coming. Many of these loans were taken out a couple of years ago, and the loan term is maturing. Most of these bridge loans have 2 to 3 year maturity, and the rate cap purchases were also 2 to 3 year maximum. So the result of this, these loans are either term maturing, or they are rate cap maturing, where the owner of the property becomes distressed. They have a situation where the debt service is substantially higher than what they signed up for originally, and they can't really service the debt. So the options, we talked about this quite a bit. The options are not very attractive. The options maybe go to investors' request for additional capital call from existing investors, reach for some rescue financing from folks, even us, our funds provide rescue financing. Some of folks that we know, they have the right type of an asset, they come in and they need a little more time to finish the value add work, and the bank loan is maturing. So they'll come to us and say, we need a little more rescue financing, and we'll line it up, but that dilutes existing investors. In fact, it actually puts existing investors behind the fresh capital that comes in. So the rescue capital generally needs to be senior to the previous capital. So those situations do take place. Some operators find massive liquidity, and they're able to get these value-add projects to the finish line and sell them in a normal versus distressed sale. Now we're coming to the land of opportunity. The land of opportunity are distressed sale situations where the owners are distressed. Sometimes the assets are distressed to a degree, sometimes they're not. So depending on the situation, this pressure over high interest rates mounts so much that the owners have to sell the properties if they can't raise the capital. And that's basically creates a distressed sale opportunity where the buyers can come in and snap a great asset at a substantial discount. And that's where the forward returns on the new capital that's going into these new deals, or the rescue capital that's participating in the examples that I just mentioned, where it comes in, it pushes all other capital back and says, now I am the last drop in the bucket, but I want to have first out, kind of last in, first out. It's called a LIFO. When I was in technology world, the term was LIFO, called last in, first out. So the money that comes in last into the deal, existing deal, wants to be senior to the other money. It's like a bucket, right? You drop the money in the bucket, and then when you want to spill, well, water in the bucket, and you want to spill the water out, the last drops are likely going to come out first. So where's the opportunity here? Where the opportunity is that when you're coming in with fresh money into these deals, and the deals are worthy, this is all obviously an assumption. It needs to be underwritten, it needs to be reviewed, it needs to look correct on a forward basis. But let's just say it's a solid deal, just needs some liquidity. And when that money comes in as a rescue capital, it will get strong terms, strong downside protection. It'll be the first money out after the mortgage. Obviously, the first lien debt, the bank mortgage is ahead of the rescue capital. So that aside, the distressed sale situations will create great opportunities for the fresh money. Why? Because distressed seller, when a seller needs to sell, and I hear this again and again, it's happening. This is accelerating, where the transaction takes place and the buyer tries to figure out why they got such a good price, why they got such a good deal, or better than they expected. And then they discover the seller loan was maturing in 2 weeks. If they didn't sell, they'd hit a technical default and they had no ability to extend. So at that point, the bank loan would be in a default. They'd be accruing default charges, fees, legal stuff, and potentially reducing the value of the asset if it's a distressed asset. So the sellers are motivated to sell. They're going to try to sell some of these assets, slightly discounting, not heavily discounting initially, and then it's a question of supply and demand, depending on what kind of asset they got, how good the long-term prospects for the property, what additional value add needs to be done on the property. They may be able to get a reasonable price, or might have to discount more, and that'll create a stronger opportunities for the buyers. So again, as a hypothetical discussion on a high level, in my view, we've reached essentially a hypersupply part of the market and part of the cycle. And the hypersupply going into recession can happen rather rapidly. So again, just to refresh, there are four cycles four phases in the real estate cycle. Typically recovery, that's after recession. Then you got expansion, then you got hypersupply, and then you got a recession. So we were just finishing up kind of the peak of the expansion, and suddenly we moved very quickly into hypersupply, and we might very quickly move into a recession phase, but it's not going to be a recession in general for all assets. It's going to be for specific assets. And just to be very clear, office space is already in a recession. Office space has been put in recession. Some shopping plazas, some industrial, those assets are generally not in recession at all. They are in sort of early parts of the hypersupply part of the cycle. But it's a very dislocated, abnormal cycle. It's just sort of, it's going to be, for certain owners, it's going to be totally smooth sailing. They locked in long-term fixed rate mortgage. They got great tenant mix in the commercial side, and they have years worth of smooth sailing. And some other situations are going to be distressed. They're going to be essentially files that will need to trade. They'll need to sell at a discount. And then the new capital that comes into these distressed sale deals, the forward returns should be substantially higher. And I mentioned this in the past, but this is incredibly powerful. The fact that the interest rates are actually high now, and they're high on a relative basis as part of the cycle. They were low when the Fed was about to start tightening, and now they're high. They're at the end of the tightening cycle, and the Fed has very little room to go up. They probably have maybe one more quarter, and we're recording this in late May 2023. So if they tighten one more time, okay, but that should be the last tightening exercise in June. It's not clear if they're going to do it. They might be done at this point. But even if they do it, they're at the end of the cycle. So all the forward outlook is going to be rates going down. And that's actually good news. If you finance today, you're picking up the rates that are relatively high. But if you got a great deal, that's the opportunity. You'll be able to refinance the deal when the rates cycle back down. So what's really interesting, as I mentioned previously, the fact that in the residential space, some banks are beginning to offer a buy down rate type of option where the buyers pay down 6 points to buy 2% reduction in the interest rate per year is an indication that the likelihood is such that the Wall Street or the financial markets are projecting, expecting, speculating, but mathematically they believe, the markets believe, that the rates are going to start cycling down sooner rather than later. And as a result of that, they're willing to offer low interest rates today if they get enough fees up front, these points up front. So that's actually a positive news for the great deals that folks can acquire in this environment. Now, you have to be patient. As an investor in this market, you cannot be overly eager. I want to put the money to work just because you have a deal showing up. It has to be a great deal. This is the point. You have to understand and absolutely believe and do your own due diligence and underwriting that it's a strong deal, that it's a strong deal. The property is being acquired from a distressed seller at a meaningful discount. This is rescue financing at the strong upside, limited downside type of environment. And when the interest rates will cycle back down, then the opportunities to come in and refinance these assets at a low interest rates will create even more upside on these properties. So I've talked about this in the past. I'm very excited about the upcoming future, even though it kind of feels like things are slow, transactions are not happening. You're sitting and waiting for great deals, but they're not yet happening. We're happening in a limited value. Patience is a virtue. Of course, it's hard to be patient, but the opportunity is significant to step into these distressed and discounted deals when they hit the market. So my view, the purpose of this video is to compare and contrast forward investing in residential real estate versus commercial asset classes. And in my view, I believe that, and again, this is a crystal ball discussion, right? I don't have a crystal ball. Crystal ball broke. Who knows what's going to happen? Can't find another one for sale. So it is obviously forward-looking, it's speculative, it's uncertain. But what I perceive is that better opportunities will be surfacing through rescue financing in commercial deals, multifamily, storage, industrial, so on and so forth. And similarly, new purchases from distressed sellers. These type of deals will be better risk-adjusted return on a forward basis for the fresh money. Now, you can ask me the question, what about the money you invested a couple of years ago? Well, that money is obviously going to be fighting for survival. I don't know how to put it. I'm not trying to be negative. Some deals absolutely fine. Some deals will work out to be good. Some deals will struggle, and some deals will fail. So you absolutely have to go through your portfolio. You have to understand what you got. Some assets will be, unfortunately, in difficulties, and some will be just totally fine. But this presentation, this discussion is for the forward money, for the forward capital. Can it get better returns by going into residential real estate, or can it get better returns by going into commercial real estate with the proper underwriting, proper operators, proper patience, proper deals in the right markets? That's my view. So I believe commercial will present better opportunities than residential because commercial is going to hit distress way faster than residential. Residential with limited supply, just distress is not happening. Commercial, it's already happening. It's happening and it's accelerating with these high interest rates. That's it. I hope you understand the opportunity ahead, and looking forward to be working with you on future deals. Until the next time, thank you kindly. This is Big Mike. Thank you kindly.